Hello, everyone. Welcome to EPS Momentum on this Sunday morning. What I would like to do today is to go over the basis of EPS Momentum and how it helps you pick stocks. You'll see some very powerful tools here this morning, and yeah, let's get started. So, when you log into the application, you have a series of widgets here that you can basically turn on or turn off as you wish. They all correspond to some aspect of each stock. So, the signal widget, matrix widget, and so on. Um, but the entire system is evolving around one model that is um, fairly similar to Investment Business Daily, but with lots of tweak, I would say. So it's really looking at the S curve of each product or each company, launching a product, introduction, growth, mature, and decline, and in during those periods of introduction and growth, there's always acceleration in earnings and sales, and this is what we're trying to capture. So in order to do so, what we did is we scored all stocks from plus 50 to minus 50 based on both the earning per share and the sales momentum breakout of each of those stocks. The interesting thing is, out of the 4,500 stocks, there's a good 3,000 or yeah, I'll say 4,200 of them that really are below zero here, an EM negative EM. So that means that all the stocks may have some positive growth in their earning and sales, but it's not as significant enough for you to spend some time on it. And the rest is really negative, completely negative. A stock that has a score between 0 and 20 has one of the variables, either earning per share or sales, in breakout mode. And a stock that is above 20 in EM is a truly a winner, right? So that's the start. The second thing is the timing. So you can see there's two part here: fundamentals and timing. So you can have a good stock, but it's the bad time to buy it, right? And conversely, you can have a very good timing and of a bad stock. So um, how do we compute this? How do we look at this? So first off, we look at several, I would say, ranges. So there's the short-term range, medium-term range, very short-term like daily range, and we look at moving average. That's what the timing momentum score is based on. Moving average and distance to high, and and also outperforming of the market. So this is all contained into the timing momentum. The TM bias is the 3-day window of this green um, indicator that you see here. So the the green indicator here is the timing momentum. It has to be above zero. The yellow, same thing. It has to be above zero. And the blue is the ratio of the stock to the S&P or the SPY ETF, and has to be above zero as well. So when all three of them are above zero, as you can see here, that would be a good timing to buy around here, right? Now, don't forget, it's EM10, so it's actually a good stock. It's decent, but it's maybe not enough. This was EM30, and as you can see, you would have bought the green would be positive, yellow positive, blue positive. So this would have been a good time to buy at 468. It's now 623 in about a month and a half, right? So this is the timing. So again, earning momentum, timing momentum, those are the two cornerstone of our model here. But obviously, don't take that model from for what it is, like a signal, and just buy blindly and sell blindly. This is not investment advice. So this is just advising you to research some stocks versus others. Now, if you were to apply the strategy, because many people told us, what's the performance on the strategy? This is what the journal is about. So you click on journal, and then you have the P&L based on a sell at a trailing stop and a sell at a fixed stop or a sell at an adaptive stop. So it's the same buy if you wish, but it's a different stop system. So S1 is trailing, S2 is fixed, S3 is adaptive. So I'll go over them quickly. Trailing stop, we put a 7% trailing stop price on every move here that the machine makes. It's really paper trading. And you can see the P&L. So sometimes it's negative, sometimes you lose 7%, sometimes you lose 0, sometimes 0.29. But when it goes up 33%, 11%, and so on. So it's usually tilted to the positive side. With the fixed stop, it's much different. We have 1,000% return. So uh, that's really very good performance. We found the stock 2013 at 37, and then it closed at 462. So this is really impressive. And the adaptive stop is the third one, where there's a 235% performance. What it does, it actually reset the stop if the EM drops below 20. So imagine here, this is 30, and then the stop is at 7%, and then it goes to 10. So we reset the stop 7% below that point here. Okay, so this is the strategy. Again, don't take it literally and just like buy and sell and based on that. This is not investment advice at all. This is really telling you which stock you should study, right? Which stock you should spend 30 minutes on of your week or an hour on your week. The big challenge is at the bottom you have a screener. Sorry. And if on the screener we have 4,700 stocks, right? So this is very, 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 very big. And the first question is, where do I start, right? Which out of 4,700 stocks do I start with? Well, that's why we created those buttons on the top where very quickly you can click on best stocks, and it would go to the screener and find the 46 best stocks for you. So what do you mean by best? We mean EM20, TM above 0, market score above 0, so beating the S&P. Timing bias, we can leave it like that. It's very stringent, but we can make it above 0 if you want. Market cap, like $1 billion, but we can go lower. And this is really like the distance to high. So we want stocks that are 25% distance to high, or you can do 10% distance to high. And then you really have stocks that are making their new highs. And then we can have a look at it. So ServiceNow, you see it's green and green. Look at this. It's a rocket ship, going higher and higher and higher. If you'd have started this effort here, we would have captured it. Well, I mean before here, but see, there's an EM25 here, 20 at 360, and it's 1,200. So 360 at the beginning of 2023, you would have triple your money. So that's truly impressive. Again, here you can go back in history, way back, way back. There's lots of 20s here. Wow. Okay. So here, there's actually 19 here at 60, but there's another one at 70, and then the rest is history, right? So this is how the system has really been designed, is to help you find the next Google or Facebook or Nvidia, right? So we can see this. Great. So now let's analyze the stock, right? So EM is fairly great, but can I look inside that black box? Yes, you can. You click on the matrix, and then you look at the actual numbers. So this is the latest numbers published. So you can read 292 versus 372, and then you can compare them. So the difference between the two is 27% growth. This is the acceleration. So it's the change between 32 and 27. So it's decelerating but growing. So that is very good. And you can compare earning per share, and you can also compare sales. So sales, you have it here. It's 2,200 compared to 2,700, 22% growth, and a little bit of acceleration, not too much. So I'll say flat in sales, and well, not flat, man, growing 20% in sales, but the acceleration is kind of flat and decelerating in earnings. right? But still a 27% growth. So very, very good growth here. Truly impressive. Um, you know, so this is very good. Now, further than this, these are numbers produced by the company, right? Obviously, those are reported numbers. But what you want is you want to know what Wall Street thinks about it, right? So Wall Street would be on the earning per share revisions. So you would click on the revision widget here. So on the revision widget, you have it there. What it is really so there's a bunch of curves here, but let's pick just one, which is the first one, the yellow. So it says the revision scores. Those are number provided to us by Zacks. You have the revision score data here. It comes into, I call it spaghettis because they're all disjointed time series. So Q quarter, next quarter, Q year, next year. And you can see how 90 days ago it was 166, now it's 177, 194, now it's 207, and so on. So it's been improving, and we capture that change. Every time that there's a change, positive change or negative, we capture it. And this is the change since the beginning of the quarter, 12%. So from that day here, we calculate a change of 12%. Now you can also have it on the chart here. You click on data and then revisions, and then it restart the chart and brings the revisions here. So you can see how revisions have been going higher up, and sales and the price as well. So we can see that it went up 12% or 11.56% since the beginning of the quarter. So quarter most likely was there, and it shoot up very nicely. So this is very good, and this is something you want to watch like very closely. So let's look at Palantir, for example. Same thing. Look at Palantir. Stock is up, it's a rocket ship, and the revisions from Wall Street is 45%. That is truly insane, really insane. Um, this is really a stock that is going to the moon. I would say. Well, at least from what Wall Street say and all the revisions. So there's another data set here, which is RS2, which is a different way. We have a different analyst. There's 11 analysts compared to 8. And these guys were up 89% in terms of revisions. So again, you can find the data right there. So sometimes the data is a little spotty. Sometimes it's not. It just depends on how we get the feed. So so that's the revisions. So we've looked at the matrix, so the earning per share. We looked at the revision of those earning per share, and now maybe I want to look at the P ratio. And for this, actually, what we can do is we can look at AMD, for example. I go and NVIDIA, right? So NVIDIA, let's have a look. Okay. So we have a different view on what a P should be. So the P ratio you hear on CNBC is 64.45. So that's the trailing PE. The forward fiscal year is 51. Year 2 is 36. So fairly expensive, you would say. Maybe or maybe not. What we're doing here is we are taking, and we can remove the PE here, and a little bit of a drop here. But what we do is we take the PE ratio, and then we calculate the earnings that you're going to get on year 1, 2, 3, 5, and 6, 30, right? Years. So if you want to spend $142 buying NVIDIA, then on year 1, you are going to have about 5 cents in EPS. Sorry, $5 in EPS, right? So if we go back to the earning per share, if you sum up the next 4 numbers that are estimated for the year, it'll be about 5 or 4 point something. Okay. Year 2, you're gonna get $8. Year 3, 5, you're gonna get 37. And all the way to year 30, where we apply to all stocks a 3% terminal value or growth, and see the growth declining here. So that long-term growth is based on Wall Street as well, and the target price as well. So based on the long-term growth of 20%, we can say that your $142 that you will spend, you will get a cashback PE in 11 years. So it'll take you 11 years to get your money back, right? To get your $142 back. So that's one thing. And let's have a look at AMD. So AMD has a growth of 2850, which is greater than Nvidia for some reason. You're going to get $3, $4, $19, and it's going to take you 17 years to get your money back. So it shows a classic P of 49, but really a cashback P of 17. So AMD is way more expensive than Nvidia, right? So let's go back to Nvidia. P of 49 for AMD, P of 64 for Nvidia. So you think Nvidia is more expensive, but it's actually not. It's actually cheaper based on growth and price. So, and we can go to Intel as well. See where we want Intel. Intel is a 45 PE, so it's truly expensive, 10% growth, and only shows a P of 18. So you would think Intel is the cheapest. Well, it's not, right? So taking growth into account. So yeah, this is very, very useful. And you can search on the screener for that very quickly. You can go into this, search for P ratio, price analytics, and then you look at cashback PE mean, and then you would say, okay, I want a cashback PE to be not too expensive, let's say below 20 or 18, and now I'm getting 19 stocks. Not only they're great, but they're cheap growth stocks. So 16, 8, 13, and so on. So I can go into Deckers Outdoor. This is PO 16. It's truly up 29, 24. So these are very good stocks to have a look at. Now we can look at another thing that is very, very popular with our user is the drift. So the drift is basically the post-earning announcement drift. So it's a statistical calculation of how the quarter is actually unfolding. The big difference from our system to other systems out there is that we compute everything on quarters, meaning we look at stocks on a quarter by quarter basis, but they're earning quarter, not the calendar quarter, because this is how really stock breathe, right? So we look at the quarter here, and we see 1 quarter, 2 quarter, 3 quarters. So we went back, 40 quarters back, 33 here, but 40 quarters back in general, and we compute all of them into the first 24 hour of behavioral reaction from the market. The initial reaction from the market, and the reaction is always positive overreaction, negative overreaction, positive underreaction, and positive overreaction. So there's really 4 cases: A, B, C, D. Today it's in case B. This quarter is in case B, which means that the market positive overreacted to the stock. So what does that mean? So positive meaning they were enthusiastic at the beginning, very enthusiastic, but they overreacted. So they bought too much. So during the quarter, they tend to scale back their holding of the stock. So they bought it and then scale back. So what does that do is it's a quarter where the stock tend to go up, but to a lesser extent get muffled a little bit, right? If I go to drift A, you get much more bigger growth, like 217, 266. Drift B is a little bit muffled. So here it's reaching its top and outside of its drift, right? So, and this is on the basis of 63% accuracy. So 63% of the time, the stock ends up inside that cone. So people will say, well, that's not a lot. Yes, it is a lot. It is a lot because you can do arbitrage with options, and you can basically your 50% chance on the stock, plus the options and the ability to know that it will fall 60% of the time there. You can truly short some calls here or write some puts at a lower level. And it's very, very useful for investors. So yeah, this is useful. This is used by a lot of people. So we can look at Nvidia, right? And you can see Nvidia is at the bottom of its drift almost. Lots of upside there, but still at the bottom. We can look at AMD. Like any stock, you would punch in, and AMD, see the quarter is pretty flat. The reaction has not been good at the beginning of the quarter, and maybe because of deceleration. And yeah, it should go down 3%, and it is down. And 91% of the time, it falls in that range. Granted, the range is big, but still, very, very important to know that. Now we can look into options as well. So what we do is we have the skew slope, which gives you the the feel for what's happening in the option market, right? So this chart is a little bit messy. You can filter to 3 months if you want, and you can look at 60 days to have a little bit less volatility here. But this is how it works. So the price is in blue, the skew is in red, and as you can see, the skew is the so by the way, if you don't know anything about all those widgets, you have videos here that can explain everything. So click on the video. On every single of the widgets, you have video explaining everything. So here specifically, the explanation of a skew is the following. I'm looking at calls and puts. So when you're on your IB or broker's platform, you have your calls and you put implied vols. And an implied vol is really the demand for the option, right? So you can see sometimes the implied vol on the put is more expensive than the call. Actually, not sometimes, very often. And what the skew is really is the slope between the puts and the calls. This point being more expensive than another. And you see if the skew is very, very concave here, then the slope is not that great. But if it's kind of flat like this, it's more pronounced. So there's different kind of a skew slope. This arrow here is what we look for the slope. So that's the skew. And if it's very high up, the puts are expensive. If it's very low, the calls are expensive. So let's go back to this. If it's very low, the calls are expensive, meaning rally. If it's very high up, the puts are expensive, meaning a drop. So see how the skew is rallying, the put price is dropping. As the skew is improving, the price is rallying. So it really inversely correlated to the stock. The most important thing here is the actual bottom. So when the skew bottoms and turns around, that really signifies a turnaround in price, like an actual trend turnaround. So that's really, really meaningful. Um, Good example of this is this one. You see a downtrend on the price, right? And skew rallies, and then skews start changing direction. As it change direction, the price doesn't really, but then start rallying because the skew is dropping, right? So there's less and less bearishness. So it's very important to capture where the skew level is. Skew here on the 60-day is at 13 percentile. That's the implied vol. Sorry, the skew is 25, but the implied vol is 13. So you have very low implied vol. So if you have very low implied vol, you're better off buying the options than selling. First thing. And second thing is, should you buy a call and a put or a put? So if it's 25 percentile, that means the calls are expensive and a put are fairly cheap, right? So if the calls are expensive, that means that people are pricing in a rally, so it's very bullish. or bullish. And on 30-day, it's 43, and actually implied vol is 0. So it is bullish or very bullish. So this is very important. Another bias, when you look at the drift and you have your options and underlying price, you look at the skew again, and you're like, okay, now on top of the drift, I also have the option market telling me that it's very bullish on a 30 to 60-day view. Okay. And then I can have a look at the dark shorts, which are OTC volumes. And you can see institutions. So this is not retail volume, it's really institutions buying the stock while it's making a low. Most of the time, institutions are pushing the stock up in a rally. See how this shot up and created a rally, and then went down, downturn, and then rally again, and then downturn, and so on. So they're really very correlated. You can also put it here. You can put the dark short and the dollar flow in there, and that could help you visualize that. All of these data points are inside the screener. So in the screener, you can look for, again, I have my 19 stocks here. I can look at my dark short percentile. If I have one that is very high up, free stocks, Shark Ninja and Coinbase, I can look at Coinbase. Institution are buying Coinbase a lot. It's an EM22. It's at its high. I'm pretty sure the skew slope is bearish, is bullish, sorry. Yeah, it is bullish, like very bullish, I would say. Implied vol is fairly in the middle, but the skew is super, super low. So which means a lot of calls are being bought. So yeah. Very quickly, as you can see, you can in your screener get some skew data, price analysis, and so on. And finally, I'm going to leave you with one very important metric, which is the, we'll have a bunch of statistics. So the price in statistics, the 60-day sigma, 250-day sigma, the ranking, the price slope, and so on. Same with the volume, same with the market score slope, and so on. But we also have the ratio of the S&P since the earning date. So this is this field here, which is very, very key, I would say. So I'm going to remove this filter here of the dark slope and focus on the stocks that have been outperforming the S&P. So this is really the change of the ratio of the stock to the S&P since the last earning day, right? So this is, let's sort this out, and we can see Applovin, Celestica. So Applovin is an obvious one, but Celestica, let's have a look. Wow. So, this is the market score, so the ratio of the stock to S&P. We can see an enormous rally here based on the price change. So really, you can see stocks that have all of these are the winners that have outperformed the S&P. It could carry on, it could not, but the most important thing is when it happens a couple of days after earnings. This is how you spot the winners. They stick out from the crowd, and Deckers is one, SoFi is another one. So again, these are winners. So this is how you spot momentum beating the S&P, momentum beating the earnings. I mean, having great earnings and sales. It's all about momentum, earning, price, and sales momentum, EPS momentum. Really summarized in 30 minutes. I hope you find this useful. If you sign up today, you have 50% off, $29.99 a month to find great stocks. It's really, really affordable. Once you sign up, you can actually click on that little cell here, or little drop, and you get daily notification. We will send you by email the top 10 of that search on the screener, pre-canned searches, and there's a ton of them: drift forecast, acceleration, revision winners, technicals, anything you would search, and it would produce the result or send it to your email. That's it. I hope you find it useful. Let me know if you have any question at support@epsmomentum.com. Thank you very much for your attention. And have a great Sunday and a great week. Thank you.